Well, folks, the flapjacks are being flipped just perfectly. Look at some of these stocks staying red hot. SoFi today getting close to touching $20, almost close to $20. This stock was $6 last year. It really goes to show you how well some stocks can perform. And it's not like the market has been, extraordinarily great over the past year. But yet you look at SoFi and it's like, oh my gosh, from $6 to touching 20 here today, right? AMD continues to roll, now up $66,000 on AMD stock in the public count. That stock continues to perform tremendously. Palantir, like, you got to be flipping my flapjacks on this one. Come on, man. Like, Palantir just shows strength on strength on strength. Every time you think, like, okay, Palantir's got a top, like, somehow it comes back stronger than ever. Now up almost 1,800% on Palantir stock. Meta continues to roll. This stock closing at $720+ a share here today, up $968,000 on the stock in the public count. That does not include the profits taken on this one. Zuckerberg continues to just absolutely take everybody's top talent in the AI space. From what I've heard, OpenAI is losing the top AI talent left and right to Meta. This news just came out yesterday. Apple's top AI executive is leaving for Meta's new super intelligence group. Unbelievable. Zuckerberg, man, he's working on stuff. That's all I'll say about that. Okay. Alrighty, guys, in this video here today, we're going to talk about where this market's headed, in my opinion. I really want to touch on the market. And where do I see the stock market headed? Do I think we're about to crash? Do I think we're about to take another leg higher here? Do I think it's somewhere in between? What stock market indexes do I think will perform the best? We're going to get into all that in this video here today. Okay. Second thing I want to get into is some stocks that I think will do very well given where I see the market headed from here. And the third subject we're going to get into in this video here today is Tom Lee. Tom Lee went on Closing Bell here today, had like a 20-minute in-depth discussion, or maybe not 20 minutes, maybe more toward 15 minutes, that I'm looking forward to reacting to with you guys at the end of this video here today, because I know a lot of times I only put like a small segment on YouTube of what Tom Lee says. There's a really good talk here. Scott basically goes back and forth, kind of pushes back on some points here. So really looking forward to reacting to that one in this video here today. And I'm doing that to celebrate the big milestone that was hit yesterday. By the way, one thing only I need from you guys. Oh, it's all I need. Smash the like button on this video. I hope you can do that for me. Smash that thumbs up button. That's all I need from you. If you want to subscribe here to the channel, you can certainly subscribe. I think we're getting close to, I want to say 870,000 subscribers here on the channel now at this point in time. So really, really big number. Like, I appreciate everybody for being here. But huge milestone on the reaction channel yesterday, and that's why I thought it'd be cool to do a reaction on this video here today as well. Because yesterday was the big day. We hit 100,000 subscribers on the reaction channel, which is called Jeremy Lefebvre Makes Money. I'm sure a lot of you guys are subscribed over to that channel as well. My gosh, what a milestone. I appreciate every single person that supports the channels, obviously. And, this will end up being my 5th silver play button on YouTube, which means, 5th different channel I've had to hit 100,000 plus subscribers over the years. And so, man, just very, very thankful. It still means a lot. You might think it doesn't mean anything. No, it just like the next stock is great, right? And you still get excited about the next stock and the next stock after you've had success. Same thing on YouTube, man. I still get excited. I'm still looking forward to whenever that next silver play button will be sent to my house. It's exciting, right? So, alrighty, guys, appreciate you being here. We got a lot to get into here today. All right. Here's where I want to start. Very important we start right here. So, what am I showing you? I am showing you a 1-year chart of the VIX, the S&P 500, the Qs, and which Qs, just think about it as the NASDAQ, and the IWM. Okay? Now, what's interesting about looking at a 1-year chart and kind of really zooming out at this market, because I understand this year has been crazy, right? 2025, it was straight risk on, into straight risk off, into straight risk on. Like, this year has been insane. But when you look at it over a 1-year chart and you zoom out a little bit, you begin to look and you say, everything's going exactly as expected here. Like, this is what you would expect over a 1-year basis. So right off the bat, the VIX is up huge over the past year. 35. It's up 35%, right? That doesn't surprise me at all. What did I tell you guys was going to happen? T-Man getting in office, like, the VIX is going to spike huge, right? Biden, Biden, you didn't hear a lot, right? Trump, it's every day. Every day. Trump's doing this. Trump's all of a sudden tariffs, blah, blah, blah. Besant said what? Who said what? What? Every day. Drama, right? And so the fact that the VIX has exploded this year doesn't come as a surprise at all to me. That's to be expected, right? Additionally, look at the S&P 500 up 11%, the Q's up 11%, the IWM up 9%. That's about to be expected. Like, that's usually roughly how the stock market performs in recent decades. So none of this really comes as a surprise. Where things start to get really interesting is you look a little deeper here, okay? And this is just year to date. So this is 2025. Now, when you look at this, what's interesting is not the Qs and the S&P 500. Qs up 8%, S&P 500 up 6%. Not a surprise at all. With the big, beautiful bill going through, right? A lot of that should benefit some of those big tech companies. Plus good earnings those companies have reported. That doesn't surprise me at all. The Qs being up 8% this year so far, and the S&P 500 being up 6%. What is surprising is how poorly the Russell 2000 has performed, IWM, so far this year. It's way underperformed. I mean, way underperformed the other indexes. The Russell's basically flat on the year. Flat. It hasn't gone anywhere. It's gone up and gone down, but it's at the end of the day, it's just flat on the year, right? Versus S&P 500 up 6%, the Q's up 8%. That's massive underperformance. But this is where things begin to get interesting. If you look since the April bottom, we've started to have a switch in regards to Russell. Since that April bottom, right, where the VIX has gone down 55% since then, the S&P 500 is up 18%. The Russell has outperformed the S&P 500 since that April bottom. The IWM is actually up over 20%. It is still getting outperformed by the Qs, which are up 24% since that time, but there's clearly a lot of strength in the IWM more recently, as in the past, we can call it 3 months or so, right? Now, additionally, to take this a step further, look at since the last CPI report. The last CPI report came out around, it was like June 11th, June 12th, okay? Now, what have we seen since then? Well, the IWM is the best performer of the major indexes since that last CPI came out. The IWM is up 4.4%. The Qs are up 3.8%. The S&P 500 up 3.3%. So holy smokes, this ain't no joke. This IWM's actually outperforming very, very recently, right? And, obviously in that last CPI, what did we find out? We found out inflation has normalized, right? Which is definitely bullish for the IWM because people look at that as, those small caps get hit the hardest by inflation. They also say Fed has to leave rates higher. They say the small caps are more rate sensitive. That is at least a view. It's not always true, by the way. Sometimes it's not true, but the moral of the story is that's what the market believes. So if the market believes things are getting better, then the Russell performs better, and that's what we're seeing here recently, right? So it's as clear as the sky behind my house here, okay? Very, very clear that the Russell has come back, right? There's a clear trend that the move is toward the Russell 2000. It's towards small caps because you look at that on a one-year basis and you say, oh boy, things are rough for the Russell. And then you look more recent over the past few months and specifically since the last CPI, and it's like, it's clear as day. The Russell 2000 is the move. Small caps are the move now at this point in time. Now, what does that mean? That means we're now at a stage where we're getting into an everything bull market. The thing you got to understand about the bull market kind of in recent years, since that 2022 bottom, right, in the fourth quarter of 2022, is what have people hated on the market for? They say, okay, big deal. Nvidia and the top tech stocks are all the ones carrying the market, but you're not getting any breadth in the market. You're not getting consumer staples doing well. You're not getting consumer discretionary doing well. You're not getting small caps to do well. You're not getting travels. That's been the whole point that people have made to kind of discredit this market, at least in 2023, 2024. Well, now that all of a sudden the Russell's starting to move as well, now it's beginning to get, you got stocks like Nike moving, you have stocks like Wynn Resorts moving, right? Now you're starting to say, okay, we're starting to move into an everything bull market. It's not just Nvidia going up anymore at this point in time. It's not just Meta going up. It's not just Palantir going up. Now it's like everything is starting to go up. Everything is starting to move, which actually gives a lot of fund managers comfort in the market because fund managers haven't felt that comfortable the last couple of years with just the market being carried by the top of the market. They want to see the whole market doing well. And the more the whole market does well, the more they feel like they can invest into the market and invest aggressively, right? So we're now in a stage where we're seeing an everything bull market. Now the question is, how long does an everything bull market last, right? where it just seems like just about everything's going up. Small caps, mid caps, large caps, and let's call it super caps as well. Well, I've been in the market a long time now. I think 16, maybe 17 years, right? It got started 08, 09. I have seen several bull markets, let's call it everything bull markets. I've seen some of them last several months. I've seen some of them last several years. They don't last weeks or days. They last usually many months, or sometimes in some cases, I've witnessed it before, where it's lasted years, folks. And this is just since I've been investing. I'm not even taking you back to prior to 08, right? Because there's plenty of periods I can show you there as well. But this gives you a good example of, coming out of that 09 bottom, right? In the next 5 years, what did we see? We saw an everything bull market for 5 years. 5 years of an everything bull market. The IWM over that time was up 200+%. The NASDAQ over that time was up 214%. So the IWM actually outperformed the other indexes. And the S&P 500 was up 172%. 172%. So the important thing to understand about an everything bull market is the Russell actually can outperform the S&P 500 significantly. And it can also outperform the NASDAQ. So moving into a everything market, just understand IWM comes to life and does very, very well. And I understand everybody's hated the IWM for the last 3 to 3.5 years. The IWM has not been the play. But just understand that you're going into an everything bull market, IWM will be by far the play. It won't just be that it outperforms. It'll be that it outperforms other stock market index significantly, right? Now, along that 5-year, we can call it everything bull market, you had several breaks in there. Let's not act like every quarter was up, every single month was up. You had a million different kind of small falls along that 5-year period, but you had 4 major breaks in the market. Right here in 2010, you had a major break in the market. Right here in 2011, you had a major break in that bull trend. Right here in 2012, you had a break in the bull trend, and right here in 2013, early 2013, late 2012, you had a break in the bull trend, right? And you had plenty of pullbacks along the way, but those were kind of 4 major breaks in the market. But at the end of the day, it was an everything bull market for 5 years. You could even take that everything bull market into part of 2015, and then you kind of had a major downfall there for a bit, right? So just understand, everything bull markets can last a while. Everybody thinks it's just gets over fast. No. You could be, doesn't guarantee it, but you could be looking at several years of an everything bull market, right? Now, also, you've got to think about the president. You've got to think about where the economy's headed and how that can factor in with the stock market, right? Now, first thing important to understand, the stock market is not the economy is not the stock market. There can be periods when the economy actually is doing very well and the stock market is not doing very well. There could be time periods when, the stock market is performing great, but you look at the economy and you're like, dang, that's not like that booming, right? And you could even look at the last couple of years. A lot of people feel like the economy hasn't been booming, but the stock market's been booming, right? And I could take you back to past periods, like the tech bubble popping, and that being the very next 3 years of weakness in the stock market, but it wasn't like the economy was doomed over that time or something like that, right? Now, the important thing to understand here is when a president takes over, people assume the first year is like that president's economy. Listen. The first year is the previous president's economy. So the economy you're seeing this year, I would say this is, Biden's economy still at this point in time. For better or for worse, it's Biden's economy. The same thing in 2021 when, Biden took over for Trump. That was still Trump's economy in 2021, okay? So the thing you got to understand here is the Trump economy really starts in 2026, okay? So, if you're bullish on the Trump economy, things should be very, very good. The economy should strengthen considerably in 2026. If you're bearish on the Trump economy and you think it's going to be worse than the Biden economy, then you should expect, the economy to go really bad next year. But it takes a while for everybody to get their policies enacted, right? To get tax bills changed and all that stuff. And you're seeing all the things be set up right now for the Trump economy, right? And that's everything he's been put in place this year, but you really start to feel the effects of that, negative or positive, next year in 2026, essentially, right? So that's an important thing you got to always kind of keep in mind. Now, Trump is supposed to be very pro-growth, right? And we're going to find out, if his policies and the way he's running the show is going to be pro-growth. We'll find that out beginning in 2026, right? That's a beautiful thing. We always end up finding out at the end of the day. So in 2026, 2027, 2028, we'll know. 2029, we'll know. As those years tick on, is a Trump economy a strong growth economy where we're going to see GDP expand rapidly to the strongest numbers we've seen in a long time? Or is it not going to be a strong economy? It's going to be a weak, put out the candles economy. I don't know. We're going to see. But if you're bullish on the Trump economy, just understand it's coming. It's not here right now, but it's coming, baby. Now, additionally, when you look at the market, here's where sentiment starts to matter significantly, okay? We've had a shocking 23 straight weeks where the investor sentiment has been above average bearish. 23 Michael Jordan straight weeks, folks. That's one of the longest, that might be the longest streak we've ever had in the history of the AAI investor sentiment. You can do the study on this if you want. Go to AAI.com. Go ahead, pull up the historical documents on this one, and let me know. I believe this is the longest streak we've ever seen in the history of that survey, which dates back to the 1980s. 80s! That's when I was born. 80s, baby. It's a time to be alive and back in the 80s. Listen, that's insane. 23 straight weeks. But we're getting close to flipping. You keep in mind, usually you have about 31% of investors are bearish on the market over the next 6 months. And it's been 23 plus weeks since we've had that, but it's getting close. It's getting close to flipping. What happens when you finally get to a point where you got more people that are saying, you know what, let's just put it this way. You have a situation where the amount of bearishness goes under the average, right? It seems like we're headed that way, and that's going to be an interesting moment for the market, right? Now, additionally, we just finally, after like a long time, we just finally broke the streak of people being less bullish than normal. The historical average for bullishness is 37.5% of people that do the survey are bullish on the market for the next 6 months. We hadn't hit that number in the longest time until last week. And we finally reached up to 45%. We finally went over the normal amount of bullishness. So we just are at a tipping point here in regards to sentiment on the stock market, where you're starting to get to a point where people are more bullish than normal. And it looks like you're about to have a flip where people are going to be, let's call it, less bearish than normal. But usually when you see a trend like that, you see that trend play out for months. Just as you've seen this super bearish trend play out for many, many months. Usually if you get into a bullish trend, it lasts months, sometimes years, folks. That's an important thing you got to understand about all this, okay? Now, additionally, this gives the market some comfort. We have a shocking $7.4 trillion in money market funds. $7.4 trillion, that number likely is still building. That just gives the market a lot of comfort, because a lot of these Wall Streeters, fund managers always talk about this number. If you watch my reaction channel a lot, how many times do Wall Streeters bring this up? It's a lot. They say, oh, there's 7 trillion plus over there on the sideline. Listen, here's the deal. Is that $7 trillion going to come into the stock market? The answer is no. But if the market goes down in any significant way, you could get a portion of that amount of money to come into the stock market and buy the dip, right? And that gives the market some comfort. It's just a comfort factor in regards to the stock market overall, okay? Now, additionally, we know Elon Musk does not like the new bill that went through, the big, beautiful bill, as they call it, right? And the reason being is this is going to likely expand the national debt by trillions of dollars, right? But let's go back in time a little bit. There was a big boogeyman in the market outside of just tariffs. And the big boogeyman in the market was Doge, the program that Elon Musk was running. People were scared of Doge. Oh my gosh, he's going to cut all these jobs. He's going to cut all these programs, going to cut this and that and this and that. And maybe that's going to put the economy into a major recession, right? That was a big boogeyman. It was scary. It was like, oh my gosh, they're going to cut trillions of dollars. And oh my gosh, like, can the economy last? We might have to go through a lot of short-term pain. And that was kind of the thought process, right? Well, Elon Musk is now out of Doge, and Doge was not able to accomplish very much in the grand scheme of things, right? Any numbers that they're able to save are just going to end up being dwarfed by essentially, how much spending is going to go on. And so at the end of the day, it's party on. It's party on. The government will be adding to the debt likely considerably. The government's going to spend heavily with this bill. And so party on, baby, party on. And, the money's just being spent in different areas. You got to understand, when Biden puts through bills, money's going to be spent in certain areas. When Trump puts through bills, it's going to be spent in certain areas, right? But these numbers are huge. This new bill basically includes $46 billion in money for the wall construction. Okay, wall construction, $46 billion. That's a crazy number. Additionally, $45 billion to expand detention capacity for immigrants. That's a huge number. That's going to be massive amounts of money to spend, by the government. And at the end of the day, you're talking about building walls, you're talking about detention centers, all this stuff. That's a lot of hiring that needs to go on, because at the end of the day, last time I checked, robots aren't building these things. It's humans, right? Additionally, $30 billion in funding for hiring, training, and other resources for U.S. immigration and customs enforcement. Huge numbers. And so that's a ton of hiring, if anything, right? So, and then additionally, by the way, the SALT deduction, essentially, this is actually going to impact very positively California and New York. It's going to impact other states as well, but California and New York were the top two that came to mind. Basically, California and New York have been hurt considerably the last few years by SALT kind of going away. And the fact that they raised it from $10,000 to $40,000 is actually huge for California and New York. So bullish on actually California and New York 2026 and past. Now, my guess is for the remainder of 2025. Here's where I see happening with the market. The stocks I think will roll, and then we'll get into Tom Lee here in just a moment, okay? My opinion is Russell rolls throughout the remainder of the year, right? We're already seeing the trend toward the Russell. Like, at the end of the day, it looks like the Fed's going to start their next cut cycle in September, right? If you start to have more confidence around the economy and you're getting a cut cycle, and let's say we can start to get that 10-year lower and lower, and maybe by the end of the year, we got a 10-year that's in the threes, which is possible. Right now, the 10-year is around 4.3 or so. So is it impossible to see the 10-year? If you continue to have less and less inflation worries, and you have the Fed start their next cut cycle, I think it's very possible, and you don't see any of the tariffs adding to inflation in any meaningful way. I think it's very possible to see the 10-year in the threes. 10-year goes into threes this year, along with the cut cycle, along with some level of confidence around the economy and maybe a stronger economy in 2026. The Russell's going to roll through the end of this year. Additionally, I think some big tech stocks will still do very well. Stocks like Meta, I wouldn't be surprised if Meta sees $900 this year. AMD, I wouldn't be surprised if AMD sees $200 this year. Amazon, I wouldn't be surprised if Amazon sees $250 to $275 this year. Google McDougal, I wouldn't be surprised at all if that one comes back very strong through the remainder of the year. So, yeah, I think those sorts of stocks will do very well as well, on top of all, obviously, small caps. Now, there's possibility of fall-time drama, but it remains to be seen in regards to that. This year has reminded me a lot of 2018. I've seen so many similarities this year between what I witnessed in 2018 and took place in 2018 and, what I've been seeing this year. But the thing is, I've got to see, how this puzzle comes together. And I can't clearly see it. I can't clearly see what's going to happen in the fall time to get us to have drama show as of right now. Now, maybe in 2 months, that's going to become more clear to me, and I'll be able to put the puzzle pieces together, and I'm going to be like, yeah, we're going to have a dramatic fall time. But, right now, it's still too early for me to see how these puzzle pieces fit together. And so, and maybe the puzzle pieces never fit together. Just because this year has reminded me a lot of 2018 doesn't mean it's going to be the exact same show as 2018. If we do get a situation where we do have drama in the fall time and the market falls considerably, then it will be literally an exact replica of 2018, essentially. Because if you look at how this year's played out, it's almost down to a T, perfect, lining up to 2018. The one last show here would be, we've already moved to all-time highs. We got to continue to blow through all-time highs, throughout the remainder of July and then into August. And then something has to happen come September that sends us down, right? And then in October, things start to get shakier, kind of market tops, let's call it September. And then we get a drama show October, November, December. But I don't know, man. Like, we're gonna see in regards to that. That's still a possibility, but these other two are, I would say, much higher probability. So we're gonna get into Tom Lee right now. I want to make sure you guys are aware that if you're looking to apply to my private stock group, private wealth group, if you're looking to get access to 1000xstocks.com, that will be the pinned comment down there. You can click on that, fill out a form, see if you get you access to that maybe next week or so. And once you join us in there, you will receive your Steel private stock group membership card, as well as your Steel 1000x membership card as well. You get access to all my best course curriculums, access to the private Discord chat, all that good stuff, okay? Alrighty, guys, let's go ahead and react to Tom Lee.
Certain head of research. He's here with us at post 9. In the market, good to see you, by the way.
Cheers.
Great to see you.
The market clearly doesn't think that tariff turmoil is going to hit the economy and stocks. Is that the right way to think about it?
Well, I think the economy, we've had enough data to know that the tariffs aren't necessarily hurting the consumer wallet or hurting jobs growth yet, but we're just waiting for, as Fed Chair Powell says, to see how it shows up in inflation. So I think the next 2 inflation reports are going to be closely watched, because if we don't see a meaningful pickup in core inflation and consumer inflation expectations don't move up, then it's going to give the Fed a lot more comfort about cutting over the next 12 months, and that would be good for stocks.
The president continues to talk tough as it relates to tariffs and his trade war. The market, I think, is continuing to reflect a I don't necessarily believe you mentality, that the tariffs are, in fact, going to end up on August 1st, as bad as they sound today or may sound in the days leading up to August 1st. Is that how you think the market is taking it right now?
Well, I think the market's somewhat pragmatic, and they realize the president is making statements to try to force negotiations to come to a close. But at the same time, the president is practical and knows that he doesn't want to upend the economy. So I think the market is trying to manage that balance. And yesterday was a day where they weren't so sure. That's why I think we had a lot of selling. But I think, as time passes, I do think at the end of the day, we expect the White House to find something that is a good balance between the two.
All right. So you're going on the idea, it sounds like, that you think tariffs aren't going to be as bad as the bark would suggest. Is that at the end of the day? Is that right?
That's right. I mean, tariffs are already annualizing $2.4 trillion a year, which, if you now compare it to where the budget is, it's actually neutralizing, the current budget. But it hasn't hurt the wallet and consumer confidence, and it hasn't hurt S&P earnings. So I think at the end of the day that we've had enough time pass that investors can sort of breathe a little bit of a sigh of relief and realize the tariffs, they're important to the White House agenda, but they're not going to necessarily derail the economy.
What if there's too much complacency around that? Got a VIX at 16. You said it's too soon to tell. That's why Chair Powell is waiting to see what happens with inflation. What if we just don't know yet what the real impact on the real economy is going to be?
That's true. That would be a negative fork if that were to happen, and I think the VIX would go up.
Well, isn't that a real possibility? Actually, it's a certainty. Today, we don't know. Do we?
Well, Scott, if we went down that path, then it would also open the door for the legal challenges to come back about what kind of tariffs can be levied without an appropriate process.
Sure.
So I think at the end of the day, look, investors should keep that in mind, but then they should realize we had a black swan develop in April.
April
2nd, a waterfall decline in stocks. The VIX went to 60, and everyone thought the market wouldn't recover because the Fed wasn't going to unleash liquidity, but it was a V-shaped rebound.
And listen, when is it 100% of the time, a guaranteed time, that it's a great time to buy stocks? I'll tell you when the VIX goes over 50. It's never been proven wrong. In the history of the VIX, every single time it goes 50 plus, you buy stocks, and a lot of times within a few months or within a year or so, you've already made fortunes of money. Fortunes of money. If you see that VIX go 50 plus, man, you got to be buying everything in sight. And then when you look back 3 years later, 5 years later, you're like, thank goodness I did that. I know that was scary. I know it was drama time. But that VIX goes 50 plus. That is the biggest buy signal you can ever get in the stock market.
If that should be in people's back of their mind, they shouldn't be too bothered, even if we get a bad chapter in this tariff story.
What's priced in at this point? I keep hearing from people, well, a lot of the good news now, given the rally back and the V-shaped recovery that you said, now all of this good news is priced in. Is it?
I mean, I'd say that the ones who are saying it's priced in are a lot of the folks that missed the rally. We speak to a lot of high net worth and hedge funds. Many have missed the bulk of that rally, and they are very skeptical here.
They're mad and they're hating on it now?
Yes, that's why it is the most hated V-shaped rally ever.
True.
I mean, worse than 2020 and 2022.
True.
But I'd argue that the PEs should be expanding. The median PE, the S&P, is lower than it was on the eve of COVID 2020 by 1.5 turns. So the market's cheaper, and we had 6 black swans. We had COVID, we had the supply chain shock, we had the inflation shock, the Fed's fastest hikes in history, we had Trump Armageddon, and then we had the U.S. bombing Iran nuclear facilities. 6 black swans. The market produced earnings growth the entire time. If this was a stock, we would say it's sort of indestructible and we should give it a higher PE, but the market derated.
I'm writing down as you were.
Fair play. And it goes back to a chart I show every once in a while in the private stock group. I'll post this chart that shows over the past 20 years or even over the past 50 years, all the stuff that has happened, or you can even take it over the last 100 years, all the things that have happened, all the drama, geopolitical related things and wars and inflation and this and that and this and that, right? And at the end of the day, stock market goes higher. It all is short-term drama, cause the market to go down short-term, but at the end of the day, stock market just goes higher.
You were answering that question. Can the multiple expand while earnings and margins are contracting? Can that happen? Because margins are probably contracting a bit, right? I mean, unless you're passing through all these costs to your customers, which I think a lot of companies are reticent to do. Earnings, we know, are contracting because estimates have come down by near half.
Yeah. Now, on the margin side, you have to keep in mind that if, let's say, companies are eating half the tariffs, the gasoline already offsets that. So I'd actually say there's no margin risk from the current level of tariffs.
No margin risk at all from now?
Yeah, I mean, on balance, because there's 500 companies, but I would say it's offsettable because of the way some of the commodities have deflated. So I think earnings growth is actually still intact.
But sure, we are going to have earnings growth. Growth is intact at far slower levels than we were once thinking.
However, we also know that ISM has been below 50 for 29 months, a record period below 50. And that is highly correlated with S&P forward growth. So if we get the tariffs issue settled and the Fed breathes a sigh of relief, starts cutting, and the ISM moves above 50, I think earnings estimates for next year actually go up.
So you think the Fed coming in and cutting is because they can, not because they have to?
That's right. I think the easiest way for the viewers to understand is Europe uses the thing called HICP as their core inflation.
Hold on, before we go further here. Do I see a situation where I could see earnings being revised higher in terms of earnings expectations? The answer is yes, I could see that. Let's see what type of dynamic we have. We have unemployment stay in the 4s. If we have that, along with wages continue to outpace inflation, like all this tariff talk about, it's going to cause inflation to go crazy. Let's say it never comes to fruition, right? And so wages continue to outpace overall inflation in terms of goods inflation, everything like that, right? And the wages matter much more to people because at the end of the day, everybody makes more than they spend unless they have some sort of insane spending problem, right? Which is a whole different situation. But most people, they make more money than what they spend. And so when you understand that, if wages go up, let's say 3.5%, but let's say everything that a person has to buy only goes up 2.5%, you're winning. That means you have more money in your pocket, more money to spend, on stocks, more money to spend on real estate, more money to spend on vacations, more money to spend at the restaurants, more money to spend at the mall, blah, 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 right? More money to spend on Amazon, right? All that good stuff. And so if you have that sort of dynamic, at the end of the day, could I see earnings expectations being revised higher? Yes. And also remember, 2026 will be the year that we start to see the Trump economy. And if the Trump economy is supposed to be everything it's cracked up to be, right, this great growth economy, shoot, we'll see GDP, go considerably higher and spending go considerably higher. So, this all remains to be seen. But if that all plays out, I wouldn't be surprised at all if earnings are revised a lot higher in terms of expectations.
Organized inflation, which excludes shelter, it's running at 1.9%, and they have a 2.5% ECB rate. If you use
this, like 10 times.
Correct. And if you use the U.S. measurement the same way, excludes shelter, because Europe's core inflation excludes shelter, U.S. core inflation is 1.9, and the Fed's at 4.5, 200 basis points higher than the ECB, using the exact same inflation basket.
So you think that the Fed should already be cutting?
Yes. I would say that on that measurement, because I'm not the Fed and I don't do policy, but
no. You can't fall back on that after you just lay out your whole formula as to why they should, that rate should be markedly lower than where they are now.
Okay, then maybe I'd say if I looked at where the 2-year was, like which Jeff Gunlock cites, the Fed is 3 or 4 cuts behind, yes.
Well, how many do you think we're going to get this year?
Well, I think the market's pricing in 2.6. So, let's say 2 is likely, but that still doesn't seem like enough cutting given where inflation is tracking.
So if we're 6,200...
I agree with that. That's not enough cutting for what the Fed should be doing. But with that being said, 2 cuts is likely. They're likely going to do a September cut and they're likely going to do a December cut. But I agree, they should be cutting more than that. Especially if they're only going to do 25 basis points. Now, if they did 250s, then we could be a little different. But the Fed doesn't like to start a cut cycle with 50. I think they want to start 25 and then probably follow it up with a 25 and then get us to 26 and then try to figure out, do we want to continue with 25s or do we want to amp it up to 50s at that point in time, right?
Call it today on the S&P. What's likely for the end of the year, do you think? What's reasonable? Not likely. You don't need to make an exact number call from me. But what sounds reasonable to you?
Well, so I would advance the argument that the PE should be going up because we had 6 black swans and the market has proven the resilience.
Going up to what? We're what are we, 22 times now, aren't we?
21 and a half.
Sorry, I overestimated by a half.
Yeah, but the median is only 16.8.
But that speaks a lot to what got us here in the first place. You've had this massive, large stock rally, right?
Yep.
So
so I might say...
So this is why I really like this interview a lot here with Tom Lee, because there's a lot of pushback. Here you go, this and that.
Why not the other 493 get a 2 turns multiple increase, and you'd be 6,800-ish.
Can you do that if there are questions about the resilience of the economy at this point?
I think so, because financials, industrials are interest rate sensitive, so I think they would actually reflate on the idea the Fed would be cutting. And there's a lot of tech that actually still has reasonable multiples, and of course we know the cyclicals and the semis would still rise. So yes, I think a lot could rally.
One of the knocks on the rally itself is that many stocks, as we're talking, it plays right into that story, outside of the S&P 500 are not hitting new highs. This record-setting rally would have you believe that everything is going up when in fact it really hasn't, and certainly not at the same pace and not even close.
Yes. Well, people always find quibbles with new highs, but we also know that for an institutional asset manager, it is not really excusable to be bearish when the market makes a new all-time high. So in other words, the institutions now have to start adding risk to if we're making all-time high, because it's a new bull market.
Oh, okay. So we're...
Ooh, that's a big point. Big point there, right? Institutions, big money has to start adding more risk, not less risk, now that you hit new all-time highs, right? Additionally, you got to keep this in mind. What happens when the stock market hits new all-time highs? What usually happens is the stock market hits new all-time highs, followed by new all-time highs, followed by new all-time highs. And then eventually that trend breaks. But usually you get many months, sometimes many years, of all-time highs and all-time highs and all-time highs before you actually get a considerable, many month or many, let's call it 6 month, before you get a 6 month to, 18-month downtrend in the market, you can go through many months, or sometimes many years of all-time high, all-time high, all-time high, all-time high. So do keep that in mind. At the least, you usually get several months. So assuming, we just hit all-time highs very recently, so you could push that all the way out to September into October of hitting new all-time highs after new all-time highs. Then we can see what happens after that. But you could push for several years to new all-time highs.
Get FOMO. That's going to be the next leg, is the FOMO trade?
I believe that is driving capitalism, yes. So a component of it is FOMO.
But, I mean, if you said institutions...
Oh, yeah, 100%. That could be the next leg of FOMO. Here's the deal, okay? The more money people are making in the market, the more people need to buy, want to buy, right? Especially big money. They look at everybody making all this money and they're like, dang, man, we're staying out. We got to get in eventually. And then just think for a moment, once the tariff drama gets behind us, right? Maybe we got another month or 3 months of tariff drama, whatever. Eventually that's going to be behind us. The tariff drama will go to the backdrop for a bit, right? Then imagine people start getting excited about 2026 because it's going to be the first, real year of the Trump economy. I mean, if people start getting really jacked up about the economy, you got the Fed cutting, you got inflation staying in the 2s as far as CPI goes, and it's like, oh, the tariffs didn't really add to inflation the way we thought. Oh my gosh. Do you want to talk about FOMO? You ain't seen nothing yet. If that all plays out, the FOMO, the fear of missing out, is going to be ridiculous if that were to play out. Imagine you start to see these companies' earnings accelerate, growth rates in revenue growth rates accelerate, like Meta, like Amazon, like Google McDougal. Imagine, these companies forecast a really strong 2026. You want to talk about FOMO?
Hedge funds have been more negative, right? They don't want to be negative and miss the whole thing. So presumably that negativity would turn itself as the fear of missing what could be, in your mind, a much stronger next leg even from here.
That's right. And it's merely a reorientation of perception, because the market's only up 5% year to date, but we could be up 10. So only half of the full year gains have been realized. So if someone had fresh eyes on the market and knows there's Fed being dovish and tariff risks are abating and multiples could expand, I think people could find many stocks to buy.
Okay, well, you stay with us. We will expand the conversation now and bring in New York Life's Lauren Goodwin and Charles Schwab's Kevin Gordon. It's great to have you here. You heard it right here. You sat right next to Tom Lee, and he was espousing his bullishness right in your faces. You agree with it?
I am less constructive on the policy backdrop for this market. Now, I expect that for the next quarter, especially here in the next month, as we have earnings reports start to roll in, what we expected on April 2nd and what we have gotten for the second quarter are different things. And so I think that we'll see an earnings backdrop that's... I expect that for the next quarter, especially here in the next month, as we have earnings...
Do you know what just caught my attention? Do you know what just caught my eye? I'll show you.
Start to roll in what we expected on April 2nd and what...
There it is. Look at the Russell 2000. Look at the other indexes. Remember what we talked about toward the beginning of this video.
Have gotten for the second quarter are different things. And so I think that we'll see an earnings backdrop that's constructive. I agree that we're not likely to see Liberation Day 2.0 type of movement here in the next several weeks. However, I think the reason that the market isn't pricing really the impacts of tariffs is because we haven't seen it in the economic data, and I strongly believe that that's coming. And so, inflation has been incredibly well behaved. The labor market is in better balance. Based on where the data has been in Q2, I agree, the Fed could be cutting. But what the Fed is worried about and looking at is an environment where holiday ordering, starting around now, that's where you're going to see the impact of higher goods prices. That's what we're going to see starting to hit consumers' pocketbooks in Q4. And so that Q4 timeline is where I think we start to see the impact to the data, which is when I believe the market will react to the risks that are unfolding.
Mr. Lee, you say what?
Well, I mean, a couple of things. One is, Q4 is a long time from now. And many people are saying they're expecting tariffs and prices to rise and consumers to think that's inflation. But one thing to keep in mind, a tariff is actually a tax because it is paid and received by the government which is then recycled, which is different than an inflationary cycle, which is a charge of higher prices to a consumer is then recycled by companies as profits, and it creates an inflation cycle. I would probably be more in the camp that even if goods prices reflect some bump from tariffs, and there's a lot of uncertainty whether that's going to happen, it's not going to be viewed as inflationary. And it's no different than us kind of seeing this as there was a tax levied, it's one time, and
even if that's true, you could still have a negative impact from the tariffs themselves on the economy at large, can't you?
Well, again, but the one thing to keep in mind is the movement in gasoline has already offset the amount of the tariffs. I mean, right, gasoline's down, huge. So I'm just saying that we're not, I think people are using a one model and says this is tariffs, it's 20 billion. It's missing, there's been a lot of changes in commodity prices. And more importantly, you even see it in the ISM surveys. There's a lot of pushback. I think a big chunk of it is being absorbed by the exporter, which means it's not being taxed on the American yet.
Okay. What about you?
I think that from a...
Yeah, it was, I think it was just either today or yesterday, from what I had seen, I believe gas prices are around the lowest they've been in 5 years, at least for July 4th weekend or something like that. So, yeah, I mean, he's not wrong.
Inflation perspective, I mean, you're actually already starting to see a lot of it show up on the good side. It's just being overpowered by services disinflation and shelter disinflation. I mean, even if you look at the durable goods portion of something like the PCE price index, I mean, the increase that you've seen year to date, if you were to annualize that, it's one of the fastest increases you've seen since the 90s. It's not that it's egregious and it's back to, what you saw during the, 2021 to 2022 supply chain shock. But I would say that, it's already starting to show up, but it's not necessarily overpowering all of the indexes and making inflation, at the headline level go higher. So from that perspective,
are you as bullish as Tom?
Well, for inflation, I don't have as much of a worry as I would for
the market.
Growth. But for the market, yeah. I mean, I think that when you look at the sort of the fabric of the leadership of the market over the past couple of months, but that ties into the growth story that has been relatively resilient, but also the inflation story that hasn't been nearly as worrisome. It makes a lot of sense as to why we are where we are in terms of not just one sector or one industry leading, but really the market sort of taking its cue from the fact that the economy has, generally held up better, to the points that both Lauren and Tom were making. Economic data have looked relatively resilient. It's the what's coming from here, clearly, that nobody knows. But I think that just keeps you in a low conviction environment until then.
I mean, how much higher do you think the stock market can go from here?
I mean, if you have a lot driven by multiple expansion, then you've got quite a bit, to go, especially on the tech and the mega cap growth side. Because if you looked at, a forward PE for the NASDAQ or the NASDAQ 100, you still have, pretty considerable upside if you were going to compare to where we've been in prior cycles and beginnings of bull markets, I would say, where you've got a lot more room to push higher. I would say the onus is more on the earnings growth side, not necessarily whether we get positive or negative, but whether that rate of change continues to keep up and you see momentum build into the third and the fourth quarters, and that comes from guidance that we'll get.
But the note we have on the screen right here from you is the middle one. Can we put that back up?
Yeah.
Let's put that back up, please, so I can see it again, because it said stretched valuations. Stretched valuations.
Yes.
But you're talking about multiple expansion while arguing that they're already stretched.
Yeah, but stretched valuations, I mean, they could stay that way for a while, and that's typically at these parts of the cycle, that's typically what, powers you higher, and then you get the earnings growth to accompany it after. I mean, for us, valuation is more of a sentiment indicator or an indicator of sentiment. So we use it to say, sure, yes, people feel good about the market, but also they're using that as a reason, particularly on the retail side, which is really more of the world that we sit in. For the average retail investor, retail trader who's looking at stretch valuations and using it almost as a sentiment gauge to push stocks higher, that's typically what we see at these points in the cycle. Does it mean that you still have risk to the downside, maybe more so or more protracted in the case that you get a negative catalyst? Yeah, absolutely. And that's
so the way to think about this on a higher level in regards to, is the market expensive? Are valuations really stretched? Think of it deeper than just looking at, it's a 23 or 22 or 21 or 18 or whatever the number is. Here's how to actually do it on a higher level. What you do is you first look at what are the companies that have the biggest weights for the S&P 500? What are the companies that have the biggest weights for the NASDAQ? Pick out the top 30, okay? Because the top 30 is really what drives the NASDAQ and S&P 500 higher or lower, okay? So you look at those. Now from those on an individual basis, look at the forward Ps on those stocks. Are they over 25 or under 25? If they're under 25, then likely they're not overvalued. They're likely fairly valued, maybe undervalued, right? Unless the company has some sort of situation where their revenue's going negative, okay? If they're over 25, how far over 25 are we talking? Is it a forward P of 30, 50, 40? Where are we at here, okay? If let's say it's a forward P of 30, then I'd be thinking, okay, this company's got to be a low double-digit grower as far as revenue and earnings per share. If a company's trading at a forward P of 30 and they have 12% revenue growth and 13 or let's call it 14% earnings per share growth, a forward P of 30 is not expensive. You can make an argument that it's cheap, especially if they can keep up that sort of growth rate over the next few years. Let's say it's a forward P of 50, right? 50 would seem really, really high. Well, if that company has 25% revenue growth and 25% earnings per share growth, a forward P of 50 is not high. Because if they can grow like that for the next several years, like you'll end up being like, oh, this stock was actually cheap at that particular time. So that's a way you need to think about this, okay? And then you run that through on each company, and then you begin to understand, is the stock market in trouble or are you looking good? Now, if of those 30 stocks, if 20 of them look overvalued and you got all these stocks trading at forward Ps of 35 with 5% revenue growth and 5% earnings per share growth expected for the next year, you're in trouble. On the flip side, if you run through that whole top 30 and you only got 3 stocks that are an issue, you're looking really freaking good, okay? And I would say we're more toward, probably 3 or 5 of the top 30 stocks being an issue right now. Whereas I would say probably 25 of the 30 stocks look good. Like they're either fairly valued or they're undervalued, which means, once again, outside of a black swan event, it's really hard to get the market down in any meaningful way.
Seen in the beginning of this year, whether it was everything DeepSeek related, you could bring it back to even the beginning of 2022 when you started to see a lot of really poor breadth divergences and valuations were stretched. There are points where it can be exacerbated to the downside, but it's also a reason that many traders, investors, as we've learned over the past several years, it's a reason that they've used to push stocks higher.
Lauren, when you look at that, do you look at the current price of stocks and say they're just too expensive relative to all the concerns that you still have for what's to come, right? You're buying stocks based on what you think is going to happen in the future, not where you think things are today.
I agree that valuations are stretched and that here in the next couple of months there are, let's say, potential volatility catalysts, but this has not been an incredibly macro-driven market in recent months. This has been a market that's driven by recovery, just trying to digest different policy announcements that really the market has no more visibility into than you or I or others. And so my expectation is that we will continue to see valuations edge higher here in the near term, but that this is an investor's limbo where the policy risks, though they're visible, they're not present in the data. And I think it's important that the impact of sort of price changes and starting to bear out in the market as well, the impact of tighter immigration, less labor supply, could create I'll agree with what Tom said earlier, temporary inflation shock. But when it comes to Fed policy and it comes to market reactions, even a few months worth of inflation moving back the other direction is really important.
Okay, so what about what we're showing you right?
So this I love. Crystal clear. I love what I'm seeing here, okay? So what do you have here? You have Tom Lee, bullish. Tom Lee's always, pretty much always bullish. Doesn't come as a surprise. But these other two individuals, you listen to them talk. And what do you hear? I'll tell you what I hear. I hear cautiousness. I hear concern. I hear worries about what might be coming in regards to inflation numbers, in regards to tariffs, blah, blah, blah. I'm hearing a lot of concern, worry, that sort of thing, right? Which makes me actually feel much more comfortable in the market. I hate it if everybody gets too bullish and it feels like everybody's bullish, because then it feels like there's no one left to pull over, man. There's no one left to pull over to the bullish side, so there's only downside from there, right? I love it when still folks are talking about all these bearish points and are worried and are concerned about this and that. That makes me feel so much more comfortable. Once it seems like you can't get anybody to talk bullish, once it gets to a point where you can't get anybody to talk bearish outside of the perma bears who are always bearish, that's the moment I'm going to be scared. When the woman from New York Life just has positive things to say about the market and the guy only has positive things, that freaks me out then. Then I'm like, We only got a downside from here, folks. But when I still hear them scared, talking cautious, they're going to talk like this to their clients. And at the end of the day, that makes me feel more comfortable being in the market here.
Tom, yields, which have been backing up again, right? Lately, anyway. I had asked the question a week or so ago to people whether the bond market was going to have yet another flex, whether after the bill passed, the bond market was going to say, okay, I'm going to show you again what I think about these rising deficits and your lack of taking them seriously enough. Is that going to happen one more time, to say the least? Are you worried at all about a backup in rates and the stock market not dealing with that well?
Yeah, I mean, I think as a little perspective, at the start of this year, I remember a lot of folks saying 5% is where we're going to see the 10-year, or maybe even 6%, and people were talking about numbers that were, even possibly double digits. So 4.4% to me is a huge win. But I do think one of the things that investors have to be mindful of is that the CBO does not count tariffs in their budget forecast because it's not legislated. So when you have the $240 billion a year in tariff revenues, which is $2.4 trillion without inflation over that budget period, that's not even in the calculation of the $2.8 trillion being added to the deficit. So I actually think that the bond market is saying the tariffs are actually keeping the bond market in line.
Bonds a good buy here?
We're maintaining our credit exposure in the short end of the curve, not because it's particularly well priced, but because on a, let's say, 2 to 3 year time horizon, that's a corporate backdrop that is still really healthy in the U.S., and I'll buy and hold that all day and clip the proverbial coupon. We're not taking big directional bets in duration precisely because every element of the 10-year pricing, the Fed funds rate, inflation expectations, and the term premium are all in play.
Kevin Gordon, lastly to you, of all of the sectors that have lagged to start this year, right? Let's get away from tech, let's get away from industrials and financials and comm services. Which one do you think has the best chance for the most upside over the remainder of the year?
Oh, man. Well, I will say the split that you've seen in what is considered traditional defensives with healthcare, staples, and utilities, utilities having pulled away from that pack, not just year to date, but over the past couple of years. And they're not a leader, year to date by any means. But I think that some of the strength coming from that and the fact that they haven't been, super well bid when you go into these really strong downdrafts, but also they've acted differently than staples and healthcare probably I would argue face a different set of tariff risks and geopolitical risks, are a little bit more insulated, and you add on to the fact there's probably more of a secular, AI-related theme in terms of power generation. I think that move over the past couple of years, and just the strong breadth profile of that sector this year, I think has been a pretty good standout for the sector.
I enjoyed that. That was fun. Thank you, guys.
That was fun. That was a really fun video here today on the main channel. And, like I said, I never really do reactions ever on this channel. I always do it on my reaction channel, Jeremy Lefebvre Makes Money, which if you aren't subscribed there, you might want to go ahead and subscribe. We just hit 100,000 subscribers. That's why I wanted to do this on the main channel here today. It's kind of like a celebration. But, I always react to a bunch of these Wall Streeters' opinions and then kind of make my own points off of those on the reaction channel and whatnot, right? Versus this channel, usually it's just my thoughts on stocks, my thoughts on the market and things like that, right? So reaction channel could be a lot of fun, and I'm happy everybody joined me over there. So appreciate y'all for being here. As always, thanks so much for being subscribed. Additionally, if you want to join my private stock group, apply to join their private wealth group, get access to 1000xstocks.com, all that good stuff. Pin comment down there, click on that, fill out a form, see if we can get you access to all that maybe next week, or maybe this week, I don't know, but probably next week. Much love and have a great day.